Greetings, Main Street. Today's chat, we want to talk about the recent updates on the SALT, state and local tax deduction, specifically focused on the provisions included in the House-passed bill known as H.R. 1, or the One Big Beautiful Bill Act. This topic is heating up in Congress, and for good reason. It's all about how much taxpayers can deduct from their federal taxes for state and local taxes paid, which can significantly impact household finances, particularly those in high-tax states. The SALT deduction has become a contentious issue since the Tax Cuts and Jobs Act, TCJA, capped it at $10,000 in 2018. H.R. 1 proposes to raise this cap to $40,000 for individuals and families starting in 2025, with some adjustments based on income levels. Taxpayers earning over $500,000 will see a gradual phase down of this cap. This change is estimated to cost about $350 billion over 10 years, which adds to the ongoing debate over fiscal responsibility and the federal deficit. The SALT deduction matters because it directly affects taxpayers' finances, especially in high-tax states like New York and California. For many households there, the proposed increase to $40,000 can provide significant tax relief. However, in low- and middle-income households, who typically do not exceed the previous cap, may not see any benefit from this change. Additionally, this bill introduces complex provisions affecting businesses, particularly certain pass-through entities. While C corporations would maintain their SALT deductibility, pass-throughs could face restrictions that complicate their tax situations. For families making over $500,000 a year, the increase in the SALT cap could mean substantial tax savings, allowing them to write off more of their state and local taxes. Most middle-income earners won't likely benefit much from the increased cap since their SALT liabilities typically fall below $10,000. They may find the increase in the standard deduction to be more beneficial. For low-income households, these families are least likely to benefit, as they often don't have significant state and local tax liabilities, and the large standard deduction generally outweighs any potential itemized deductions. Understanding these tax changes is crucial because these could affect the financial stability of many households across the country. Tax policy is not just a number on the page. It influences economic behavior, spending, and ultimately the overall economy. As this bill moves to the Senate, it's important to stay informed about potential changes and their implications. We'll keep you updated on how this debate evolves, especially as lawmakers negotiate to find balance between providing tax relief and maintaining fiscal responsibility. The outcome could shape tax policy for years to come, so it's vital for everyone, especially those in affected states, to stay engaged. Thanks for joining today's overview, and stay tuned for more updates on this pivotal issue. Be the change.